Salesforce agreeing to buy a software company, Informatica, in its biggest deal since Slack. We'll have the details next. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. A big rebound from a bad week. Right now, the S&P 500 up 1.2%. I believe for the week, it was down 2.7%. So we're gaining back less than half of what we lost, but that was obviously over 5 trading days. The NASDAQ is gaining more as NVIDIA is the great hope to continue driving this market. We do see in terms of that stock, it's up 2% right now, and Apple also a gainer today. So those are 2 of the 3 biggest stocks in the world rising and helping to buoy the index. P. Diddy Holdings is down almost 20% right now after, I guess there's a Temu issue there. AutoZone, same-store sales missed by like a full percentage point, down 9% and change. Salesforce making a big deal that we're going to talk about in a second, and it involves Informatica, which CRM is buying, Katie, for $8 billion.
Yeah, and it's interesting to see Salesforce shares a little bit higher on the heels of that news. One of its biggest acquisitions, an $8 billion deal. Let's break it down now with Liana Baker. She leads M&A coverage for Bloomberg News. She broke news of this deal last week that we could expect to see it this week. So let's discuss now. This one is an interesting one because these 2 companies were in talks not too far ago, and now it seems like they're finally going to put this over the finish line.
What we say in M&A circles is that no deal ever dies. We saw this with Google Wiz a little while ago, and when companies get close to the finish line on deals and they don't happen for whatever reason, we always expect them perhaps to come back. What's interesting here for Salesforce is that it's its first big acquisition since it was in the crosshairs of activist investors a few years back who were actually criticizing Salesforce for their acquisition strategy. So they had sort of taken a breather, done some smaller tuck-ins, but now they're back in a big way. But they're saving about $2 billion from when they last spoke.
So what does this company do? Salesforce, I guess, is also trying to cash in on this AI, I don't want to say craze, because it's going to be the way we live from now on, right? Is this going to help them?
From what I've read, Informatica is going to help its AI agent business. Informatica is a long-time company that I've known. They're originally in the middleware space. They actually went private almost 10 years ago by private equity. We covered the IPO in 2021. So they've sort of been around the block, but they help with data management for companies, and this is going to help Salesforce sort of roll out more of these AI features. And it's Mark Benioff's way of, coming back to the M&A market, which we'd love to see.
Talk to us about potential regulatory concerns here. That still, even under this new administration, is very much a thing. And you think about the potential overlaps here. It's not insignificant.
Salesforce owns a business called MuleSoft, which they bought also a couple years ago, which competes with this company, Informatica. So we'll see how regulators look at this one. It's always high profile with Salesforce, but it's hard to say if it's a litmus test for regulators. But obviously, any deal with a big price, with a well-known buyer, we'll be watching to see, how regulators decide whether it could go through.
All right, Leanna, thanks so much for joining us. Leanna Baker runs our deals team here on the BN side. Coming up in the next hour, RBC's Amy Wu Silverman joins us on Wall Street's hesitation to buy the dip. We will also pepper her with questions about NVIDIA. Plus, Jay Hatfield argues we will not see a U.S. recession due to his rule on housing starts, and we're going to ask him about rates as well. Remember, he had a bullish forecast, but it was predicated on 3.5% 10-year yields.
Right, yeah, which it certainly feels like we're far away from that right now. The 10-year yield hanging out around 4.5%. It feels like it was close to there when I left.
Yeah, well, it rose a little, but maybe there's more demand for long-term debt. Today, this is Open Interest. We are 30 minutes into the trading day, and we're looking at decent gains right now, 1.25%, but we had a rough week. Last week we were down 2.7%.
Yeah, we're still struggling to break past that 5,900 level as we've been looking out for once again. The bears are looking for a reason to take a weekend off, a long weekend.
Well, they have a reason to celebrate today after Donald Trump did another 180-degree turn on his tariff policy. Maybe it was more like 120 because he just pushed it back again.
We have some breaking economic data. Speaking of the bears,
Yes,
we want to put
do.
them away. We want to actually look at that May consumer confidence data. Matt, it's pretty interesting. You're looking at a 98 handle. The estimate was 87. So talking about reasons to celebrate, we're looking at the S&P 500 take a little leg higher after that news as well. Not by much, though, which shows you that perhaps people are waiting for the big moment of the week.
Well, or maybe consumers are also into the taco trade, you know? That's an acronym for Trump always chickens out. It was in the FT last week. And he says, 50% tariffs on Europe June 1st. And then a couple days later he says, we'll let them slide until July 9th.
Or as Tom Barkin told you, everyone's looking for a silver lining. Things might not be so bad.
It's all about silver linings for Chanelli. What do we got coming up?
Coming up, we have NVIDIA's earnings looming large on Wall Street. The chip maker is taking the earnings spotlight tomorrow after the bell, as Matt and I had been talking about.
Yeah, we'll talk about that more. Meanwhile, trade talk optimism is fueling a post-holiday rebound as President Trump praises the EU for speeding up its tariff negotiations.
Plus, wait-and-see mode. Tom Barkin, as we've been talking about, of the Richmond Fed, weighs in on Trump policies in a Bloomberg exclusive.
Let's turn now to this week's key event, NVIDIA's results due tomorrow after the bell. RBC's Amy Wu Silverman writes, quote, while retail had been consistently buying the dip, institutional investors hugely missed out on the recent rally, and particularly in NVIDIA. We're watching closely for those who need to jump in the pool, which could charge the rally further. Amy Wu Silverman, RBC's head of derivative strategy, joins us now at the desk. Great to have you here.
Great to be here.
Happy Tuesday, I guess, to kick off this week. It feels a little bit slow, but how much is NVIDIA going to jumpstart this market tomorrow?
Well, maybe this is the silver lining we're looking for, right? I can tell you just the amount of importance it has specifically to retail, but also to the benchmark, right? It's not just about jumping in the pool these days, but it's about that benchmark FOMO that institutional investors get. And one thing we had really noticed is post-Liberation Day, you saw this degrossing. And the issue is when you get a rip up like that, you have to jump in just as quickly. That's been the old playbook since post-COVID. We see that time and time again, that momentum fuels more momentum, and you really see that charged in the derivatives market.
How much dry powder is there on the sidelines? Realistically, if NVIDIA is going to outperform, how much does that drive money into the market? Is there a lot of upside left?
I think yes, and it's a great question because, one thing we look at is just the ETF inflows that you continue to see. They keep going. You continue to see that there has been degrossing, and so that's made in some ways the sell-off that we have had relatively orderly, but the flip side of that is it means there is powder to be deployed, and we've seen the cycles of this. The FOMO and the momentum, it doesn't happen in an orderly way on the way up. It's usually a rip up to the right tail.
By the way, I'm always fascinated when people like you are able to discern who's doing this buying, right? There's so much data. I'm sure you're using your Bloomberg terminal, but how do you look through it and figure out, okay, this rally was led by institutional or this rally was led by retail?
So I'll tell you, it's getting a little difficult because I would say maybe 4 or 5 years ago, you could do it by lot size. You could say, hey, an 8-lot trading in the market, a 10-lot trading in the market, that's perhaps a retail footprint. But now you've seen a lot of copycatting from institutional players who know that, who are masking that. I'll give you one trick using VCA on the Bloomberg terminal. You look at the implied vol of the call versus the put. If that's negative, that's a sign that you're starting to get a little bit more into that FOMO. You're getting more demand for the call outweighing that wing. We call it skew inversion, but it's essentially this idea that you better watch out because momentum tends to beget momentum on the right tail.
Cool.
Well, and momentum today is on the upside. You have to wonder, NVIDIA, with this upside momentum today at least, you're finally positive on the year. It's up about 0.4% on the year. But if you look at the totality of the Mag 7, Apple, Tesla, Alphabet, Amazon, these are more consumer-heavy Mag 7 names that are still dragging down the broader Mag 7 index. How much does that matter? Can NVIDIA pull up the pack?
Not necessarily, and I'll say, because things have gotten so idiosyncratic, it used to be the case that inter-Mag 7 correlation was actually pretty high. You actually saw it trade as a flight to safety overall, right? Like if things were bad 2 years ago, you would just flock to Mag 7. That intercorrelation was high. It's very idiosyncratic now, and we were joking before, but it's Donald Trump kind of seems to have it in for Apple. He doesn't seem to have it in for Jensen, and that may appear quite qualitative, but it's having very real economic impacts that we have to kind of discern as investors.
So who's buying Apple and who's not? I mean, do you see retail supporting Tim Cook? Do you see institutional investors fleeing the same way you do with NVIDIA or this rally?
So we have not seen that skew inversion really in Apple to the same degree that we're watching it for in NVIDIA. And I think it's, I joke about the other Greek we're facing now, which is Twitter, just the risk of implied volatility to Trump's tweets. He makes these tweets and he says, we want everything to go back to the US. I mean, how do people process that? I think both retail and institutional investors are still processing that. And that's why you don't see it in that skew inversion yet.
Tweeta and taco. I feel like I went to that over a 3-day weekend and
well, you got to imagine he has to back down on this, right? I mean, he already backed down once on Apple. He gave them all sort of tech companies respite from the big China tariffs. And now this 25% tariff, is he really going to push that through so that we're assembling iPhones here in the U.S.?
This is like when I tell my kids to clean their room, they know it's an empty threat if it comes from me. And like we're starting to get that vibe a little, it becomes president who cried tariff. And so I think you're getting these volatility swings now. If you look at Friday to today even, I think it starts to wane if you believe in the taco, right? If you believe that it's ultimately going to be followed with reprieve, I actually think you start to see both volatility stabilize as well as the markets.
I want to also point out, speaking of volatility, that we've subsided quite a bit. We've been hanging out at a 20 handle or below on the VIX lately, and it's helped fuel IPOs again, very successful ones. It's helped bring M&A back. How much does that stay where it is? Is there a lot of upside risk in volatility at this point?
I think there is, and I think it's going to be very delayed. So one thing that happened after we got the rally post-Liberation Day is VIX term structure finally inverted. So meaning we went from short-term, very, very uncertain to kind of like a more normal term structure. Long-term should be less certain than near-term, right? Now the issue with that is because we have these 90-day tariffs, we have these reprieves that keep getting pushed back, we are essentially can-kicking volatility too. That doesn't mean we're not going to have a volatility pothole. It just means it's further out than we have anticipated. And I would say that risk is still looming. It's just not right now.
How closely are you watching treasuries? Because the market setup to me today feels like a lot of what we're seeing here is about Japan, right? They make comments saying maybe they'll curtail long-end issuance, and then investors are comfortable buying longer-dated treasuries around the world, and that brings yields down so our stocks can rise.
I would say right now, the market goes through periods where it's equities leading and then sometimes it's credits leading or treasury. I mean, I think we're in a market where treasury matters so much. I think we've learned that the Trump put exists. It's just actually on the treasury market. It's not necessarily on the equities market. And I think that's going to be a huge implication not only to the tax bill that's being passed through, but to the Fed and to the markets overall on an equity level. So we are watching it very closely, and it has huge implications for volatility too.
All right. Luckily, I know you're watching it so closely, Shonali. Amy Wu, thanks so much for joining us. Amy Wu Silverman there of RBC Capital Markets. Let's get a check on what's going on in terms of the equity indexes right now, 38 minutes into the session, and we are looking at a gain of 1 1/3%, 58.81. So as Shonali says, we're getting back up to that 5,900 level. We did break through that.
There's a fear under the surface still. Why aren't we breaking through that?
Well, I think if you look at a lot of the year-end forecasts, they're for higher than that. So 6,000, 6,100, that we are getting back to that 6,144 high that we saw in February.
But not too much higher. That's the thing. I want to know what the breakout star is going to be of this market. If it's not NVIDIA, if it's not Apple, if it's not, what is it really that is going to bring you higher than the high?
Well, wait till NVIDIA earnings tomorrow after the bell, right? Because that could really push us through if they knock the cover off the ball, as they used to.
There's some stocks we're looking at under the surface this hour as well. We're looking at Salesforce higher after agreeing to buy Informatica for about $8 billion. Looking at it higher by about 0.7%. We're also looking at Trump Media. It's now lower after after earlier jumping on a report that the company is planning on raising almost $3 billion to buy cryptocurrencies, and Block is higher after getting an upgrade at BNP Paribas Exane. And coming up, we're going to talk about the cuts over at HSBC. We're going to give you the latest on the bank's restructuring plan in the Wall Street Beat. Plus, more ahead from our exclusive interview with Richmond Fed President Tom Barkin.
Inflation is a big bugaboo. Prospect of inflation drives sentiment down. There's no evidence yet that that inflation-driven drop in sentiment drops spending. And nothing I'm seeing in the real-time spending data suggests that spending is dropping. But that's why I say there's the disconnect on the consumer side.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is praising the European Union for speeding up negotiations on trade days after he said the bloc would face 50% tariffs if it doesn't reach a deal with the U.S. Trump said he will hit the EU with a 50% tariff on its goods, but extended the deadline for those taxes after a recent call with EU President Ursula von der Leyen, during which she agreed to fast-track talks. It's rare for Trump to praise the EU, which he has long derided as a scheme to rip off the U.S. And the administration is set to cancel the government's remaining federal contracts with Harvard University, worth an estimated $100 million. It's the latest escalation in the battle between the U.S. government and the Ivy League school. Since last month, the administration has frozen about $3.2 billion in grants and contracts with the university. It's also tried to halt Harvard's ability to enroll international students a move that Harvard's president said would be a devastating blow. Trump is also now threatening to withhold funds from the state of California if transgender athletes are allowed to compete in state finals there. And Cantor Fitzgerald is kicking off a $2 billion Bitcoin-backed lending initiative. It's providing financing to crypto firms Falcon X and Maple Finance. The program is the latest in a string of crypto-focused ventures launched by Cantor, whose former CEO, Howard Lutnick, stepped down in February to become the United States Secretary of Commerce. Sonali?
And Matt, I quickly want to check in here on shares of U.S. Steel, because CNBC reporting right now that Japan's Nippon Steel is expected to come in with an acquisition of U.S. Steel at $55 a share. You are seeing U.S. Steel on the rise just a little bit more. Slight pop, 1.6% higher on the day. It's trading at under $53 a share. Of course, this is a deal that has been on a very long road, but it looks like the president of the United States here is finally warming to it.
It is, I think, shocking that President Trump is going to allow a Japanese company to buy U.S. Steel to take over these assets that are so important for, at least according to what he has said in the past and according to what we hear from Howard Lutnick all the time, so important for the defense of the United States. They make the steel that builds bullets and guns and tanks, etc., and that he would allow the Japanese to buy this, I still find so difficult to believe.
It's a lot to consider between the relationship of the United States and Japan, and of course a need for this kind of deal with jobs on the line, politically sensitive, but of course there is always a path.
Is there a need for this kind of deal?
Well,
I mean,
it
as
depends.
steel prices rise, you know, they're operating at near full capacity.
You know, U.S. Steel has been on a serious slump for the last couple of years, and
the
it's
stock,
only
right?
the stock, and therefore, what would be the future? Remember, Cleveland Cliffs had come in a couple times. You actually see Cleveland Cliffs.
I see U.S. Steel up 538% over the past 5 years.
That is true, but what about in the last 2 years?
Here in the last 2 years, the stock is up 146%.
Before the deal talks resume.
It's been great for U.S. Steel.
The stock has been screaming for a deal at this point. But to your point, yes, over the long term, it has done well, and maybe it'll do well under Japan's ownership too. We'll keep an eye on that for you. Bring in Joe Doe. He's got a lot of good insight into where this all goes and what it means for Cleveland Cliffs. But it's time now for the Wall Street beat. We're talking about another investment bank. We're looking at HSBC. It's dismissing over 24 analysts as part of a new restructuring. And that includes the bank's global head of fixed income research, Stephen Major. According to people familiar with the matter, the changes are part of the CEO's efforts to increase efficiency. Joining us now from London, Bloomberg finance reporter William Shaw. Now, you look at these cuts, help us put them into perspective, because HSBC, when they have been looking at reducing parts of their investment bank, it had not been in fixed income. Stephen Major is a huge name in fixed income. What does this say about their broader strategy?
Well, I mean, in terms of their strategy, so it fits into a kind of broader move by the CEO, like you said, to pursue efficiencies and streamlining within the company. They're moving to combine commercial banking and investment banking. And then in the US, Britain, and in continental Europe as well, they've shut a lot of M&A and equity underwriting units. So it very much fits into this wider move in which there's obviously a lot of momentum into cutting back broadly across the bank.
To me, William, it's just so fascinating that they would fire Stephen Major. I mean, this man has got to be one of the most read voices in the entire global interest rates market, right? I mean, he makes big calls, often gets them right. You know, we write about him all the time. What do we know about that? Has he confirmed that HSBC has let him go? And, you know, where can he go now?
Yeah, I mean, it's confirmed. Like you say, he was a very big beast from our point of view at Bloomberg, I think. I remember when I was on the FX rates team, we'd periodically write stories based on his calls on what the bond market was going to do next, and they'd get huge readership. I mean, I don't know where he's going to go next. If anything, it just shows their commitment to this kind of move to cut back on research. I think that they'd cut back on someone so prominent. It's part of a wider move move where within that research business, they're combining macro strategy across fixed income, which obviously was his ballpark, and also asset classes like FX. Now, to give you a sense of how important the research department was at HSBC, prior to the news today, I think they had about 330 research analysts and associates, and they were covering some 2,000 companies globally. So it was like a really big player within research on Wall Street.
William Shaw in London, we thank you so very much for following this story for us. Now, still ahead, counting down to NVIDIA's high-stakes earnings report. We're going to bring you the details on that next. What to look out for, and can it lift this market? This is Bloomberg Open Interest. Investors are anticipating another strong quarter of growth from NVIDIA. Bloomberg data shows revenue from its core chip business is forecast to rise over the next 4 quarters. Here with us now, Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. In the commercial break, we're looking at a graph of the price to earnings ratio of NVIDIA. It's trading at around 45. It was as high as, or higher than 80.
Yeah.
Isn't this at a discount? Isn't the bar pretty low?
Well, so when it comes to valuation, I think what people miss is how NVIDIA has been able to command gross margins that's way higher than any semiconductor company has been able to do. Even Intel in its glory days didn't have this kind of margins. And what has transpired is NVIDIA's free cash flow would be close to $100 billion this year. Just look at the hyperscalers, your Apple, your Microsoft. They are the ones who are generating this kind of free cash flow. So gross margin to me is the key metric when it comes to NVIDIA. And those have been trending down. They were mid 70%. Right now, they're like 71, 72%. They've guided to gross margins going back up to mid 70%. And to me, that is the key determinant of multiple. I mean, 45 times earnings looks rich, but when you have the kind of durability that NVIDIA has shown, well, they can sustain the multiple provided the gross margin is intact.
I just want to point out, if you use the GE function on the terminal, which is Graph Fundamentals, not GF, GE, Go, you'll see that we were willing to pay 200 times earnings for NVIDIA in 2023. That was before we realized how much we were actually going to need to use AI on a regular basis. I'm sure you saw the Norwegian
And
wealth
what's
fund head,
wild about
Nikolai
that-
Tangen. Did you see that this morning,
I didn't,
Shonali?
but I will go back and watch it. What's amazing about that graph is that they grew into the multiple, right? The price of the stock was higher, but
and the market
earnings...
is anticipatory. So they anticipated that hyper growth, and that has continued. But the reset of expectations would be, okay, they grow 60% plus this year, and they suddenly go back to 15, 17%. That will be a big reset. Whereas if it's gradual from 60 to 30 to 25, I think that's where they will be able to sustain.
What are we talking about in terms of revenue? I mean, are they going to be doubling their revenue this year? Are they going to be tripling their revenue next year? I mean, what does the growth look like?
Well, if a company grows their revenue by 35 to 40% every year, they double it every 2 years. That's the math. And in this case, they are growing 60%. So if they grow another, 25, 30% next year, they will double their revenue. So from that perspective, I mean, there is no other company at the scale that NVIDIA is at who can double their revenue every 2 years. And that's why, they command a premium multiple. But if there is a reset in expectations, imagine one of the hyperscalers pulling back their CapEx next year. And because their revenue base is so concentrated to hyperscalers, that's where the growth risk is. And look, it's hard to offset that, even though they signed a few deals in UAE. China's revenue going away, those are the things that really affect them because these are big customers. And NVIDIA's customers are the companies that are training their own large language models so far that can, spend $70, $80 billion in CapEx. So that's the risk. If they taper their CapEx, it's going to affect NVIDIA's growth.
And that's nothing to say still of the sensitivity to policy changes. We'll keep an eye on that. We're looking forward to your coverage tomorrow after the bell. That is Mandeep Singh of Bloomberg Intelligence. And coming up, the EU is looking to accelerate trade talks with the United States. We're going to talk to Aptar CEO Stephen Tanda next. This is Bloomberg Open Interest.
The European Union is seeking to accelerate trade talks after President Trump extended a deadline until July 9th. Well, it had been July 9th. He brought it back to June 1st, and then he extended it back to July 9th for implementing aggressive tariffs. That's positive news for international companies across both sides of the pond. Joining us now is Stefan Tanda, the CEO of Aptar Group. Aptar is based in the U.S., but it's a global manufacturer of consumer dispensing packaging and drug delivery devices with manufacturing operations in 18 countries. So, Stefan, as I understand it, you make things like pumps or syringes, everything from creams and lotions to injecting medicines. Where is the most of your manufacturing? Because I want to gauge how much tariff risk you have.
Yeah, for us, tariff risk is actually quite low. And thanks, by the way, for having me, Matt. The 50% plus of our manufacturing is in Europe, and that's about in sync with our sales there. In the U.S., we have 9 plants, and they supply what we need in the U.S., and then the balance is in Asia and Latin America. And as you said, we are in a broad range of end users dealing with most of the drug companies, everything from asthma inhalers to Narcan to GLP-1. And about 20% of our business is more exposed to beauty. And while we are not exposed to tariffs, our customers are. So if you think about a high-end fragrance or a new skincare line, you're not going to launch that if you don't know what the duty is going to be, where the consumer is at. So that 20% of our business is probably the most exposed.
Well, speaking of the consumer, you did just this morning see a jump in a gauge of consumer confidence. You actually saw it jump by the most in 4 years, given the calming down of the trade talks with the administration and trading partners. Are you seeing that yet when it comes to consumer behavior? A jump back?
Well, the biggest applications for us are in treating everyday chronic conditions from allergic rhinitis to diabetes. Those are not that impacted by consumer sentiment. But again, our customers in the beauty space are rethinking their orders given the uncertainty. And travel retail is quite a big portion of that. And as you've seen, international travel for U.S. consumers has been really reduced. So we expect that to be impacted. And luckily, the 80% of our business that are not exposed to that are doing very well.
So I guess if you see a drop in travel, that means fewer of us are going to be going through duty-free and buying whatever perfume for whom you make dispensers, right? So you also do packaging for Gatorade, for Heinz ketchup, for Lysol air fresheners, these sort of regular everyday grocery goods that we all buy. What kind of demand are you seeing there? Is it unaffected as well?
That is unaffected, and it continues to go very strong. We are lucky that we're, one, making in region for region, so all this tariff stuff doesn't impact us there. And then people have breakfast, lunch, and dinner. In good times and bad times, they need their drugs, so we're quite resilient, and you're quite right, whether it's beverages, whether it's condiments, not just in the U.S., but also in Europe and Asia, that continues to be very strong. Actually, we see a re-acceleration in Europe and Asia. The Chinese consumer is coming back. So overall, we're quite bullish for the second quarter, again, save the beauty business.
But do you see, Stefan, these big household names that are also global vendors, do they buy your products where they sell them? So, for example, if Gatorade is buying something from you, do they buy the U.S. sale from your U.S. manufacturer and then the European sale from your European manufacturer?
Yeah, you're absolutely right. So for things like food, condiments, beverages, personal care items, those are really bought in region for region. There are some companies that buy from our Mexican facilities and then ship the finished product to the U.S., but all covered under the USMCA. It's more these high-end products, luxury products that, for the brand interest need to come from France or places like that where they cross-ship. Also, some of our pharma customers cross-ship to some extent, but of course, there's a lot more space in the P&L for that.
Stefan, I appreciate that much more of your business is tied to pharma than, say, beauty products. But when you look at the administration's strategy here, tariffs have really taken up a lot of the air in the room for investors. But there are also sweeping changes being made on an industry by industry level, particularly pharmaceuticals. What does it mean for your clients, and how much are they holding back until the air becomes much more clear?
Yeah, so there's a lot of uncertainty, and for us, we see both puts and takes. Take for tariffs, for example. Some of clients who stop buying from us in the U.S. And rather bought products from China are coming back and buy product from us, so that's a positive. For our clients, shifting manufacturing locations, that's a long-term proposition. So we really don't know the secondary and tertiary effects until all of this has settled out. So you will see some supply chain whiplashes based on the latest announcement or where the negotiations go, but nobody's going to move factory based on that. Once the picture is clear, hopefully in the second half, we will have some time to figure out the secondary and tertiary effects. But again, for us, it's quite simple. If the pharma customer doesn't want to buy in Europe but wants to buy in the US, we ship them from the US factory. If they want to move something from Asia to Europe, we ship them from the European factory. So having this robust and resilient supply chain set up, making in region for region, has served us really well.
Let me ask finally about sort of the baseline demand for GLP-1s, because in terms of the pharmaceutical products you sell, if you have diabetes, you're going to have to buy the product, or obviously if you overdose on something, hopefully you're going to be able to get some Narcan. But the demand for GLP-1 should be a little bit more elastic. Do you continue to see strong demand for those weight loss drugs?
Absolutely. We're still in the ramp up of capacity in the supply chain. We ourselves are not capacity constrained, but there is a lot of need for additional product. Clearly, the pharma companies are reducing prices somewhat to kind of catch that next layer of consumer spending. So I think there's a lot of growth left in GLP-1.
Stefan Tanda of the Aptar Group, we thank you so much for your time and, of course, walking through all the implications of the policy changes we're seeing. Matt, we are near session highs in these markets. What are we seeing?
Yeah, we are. I mean, I'm looking at the move screen here, which I think is really dynamic and a great way to look at any index. You can see here what Shanali said. We are up near session highs and really strong breadth. 459 stocks up, 43 down. So we're crushing it today after the drops that we saw last week. Remember, it was the worst week since April 2nd, and we'd had bond yields rising for 4 weeks in a row. That's the first time we've seen 4 weeks of yield gains this year. But right now, NVIDIA really leading the charge. It's up almost 3%. That adds 10 full points, almost 11 points to the S&P 500. Microsoft, Tesla, Apple, Amazon, obviously Google, these are the biggest stocks. All of these Mag 7 stocks are all in the green right now, adding to this index. In terms of the losers, you see Fair Isaac Corp right now down almost 10%, almost, I guess, 9%. So getting decimated there. United Health continues to have a tough time of it, and AutoZone missing expectations, which is interesting because I spend so much money there. In terms of the consumer groups, or in terms of the economic groups, I should say, moving consumer discretionary is the biggest gainer today. So that's how you can tell this is a really risk-on rally. They're buying consumer discretionary. They're buying IT. They're buying the hyperscalers, which are what you see here in communication services. The defensive sectors are losing, Shanali. I mean, they're down at the bottom of the list. They're not losing. They're still making gains, but utilities, consumer staples, and energies are down right now, and that means that the defensive trade isn't what's driving what we see today.
Very true. Finally, at least for today, the bears are hiding. Now, coming up next, Jay Hatfield, CEO of Infrastructure Capital, why he's expecting a summer power rally. We're going to talk to him about what he's buying next. This is Bloomberg Open Interest.
Nothing's really changed in the economic environment. You just have policy uncertainty. And I think people are just going to wait policy uncertainty out. They do think there's a light at the end of the tunnel, that there will be some certainty, whether it's the tax bill or some of the trade terms. But I think they're just waiting it out.
Richmond Fed President Tom Barkin speaking with us earlier. Super interesting conversation. And here to help unpack it, Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Management. Now, Mike McKee asked him a question about whether he's more focused on the employment side of the mandate or the inflation side of the mandate. And he said you could see it both ways. You could say oil prices are coming down, or you could say tariffs are inflationary. How do you see it, and which side is the market more concerned about?
Thanks, Chanel. That's great to be on. We think that they will take the employment market seriously, and we are forecasting that it does weaken but not crash. And if you look, the Fed doesn't really like leading indicators for some reason, but continuing claims is the key leading indicator, and they are rising slowly. So we think that's what's going to precipitate the Fed cutting, because they're going to be a deer in the headlights because they don't understand how to deal with tariffs. I think Waller has it right. That's how we look at it one time. They believe in the expectations theory of inflation, which has been discredited. And so we think they'll figure that out in the next couple of months as we get this inflation data, continuing to be very, 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 very cool.
So are you then worried that the labor market is going to come under significant pressure? What kind of unemployment are you expecting? Are you going to see big layoffs?
You know, the really, really strange thing about this economy is normally what you have is a tightening of monetary policy, rising long rates, which we've had, and the housing market crashes. But we still have a shortage of housing. So the housing market's actually hanging in. We had 750,000 new homes sold. We still have 1.5 million of starts. So normally you get these big layoffs from construction, because you never keep construction workers around, and that precipitates a recession. But we don't have that right now. But we do think there's a cap on rates about 450. So you notice they always melt down. That's when the 30-year goes over 7, which will put even more pressure on the housing sector.
Wait.
Seven.
Say again?
7.
So you think the 30-year yield is going to go over 7?
Oh, no, I didn't say it properly. Sorry.
Yeah.
So when the 10-year is at 450, the 30-year mortgage is over 7. That's a key word. Right? There's 250 spread right now between the two. And 7, most real estate professionals believe, is where the housing market comes under dramatic pressure.
And we have to say that's all as they're talking about the Freddie potential privatization. What are your thoughts about the rate cut potential this year by the Fed? You have less than 2 cuts really priced in at this moment. At the end of April, there were as much as 4 cuts priced into this market. Where are you?
We've been at 3 all year long, so we're pretty boring.
For 2025?
Yes.
Because
at the beginning of the year.
Morgan Stanley's cross-asset team, Serena Tang, I think, leads that team. They expect 7 cuts through 2026.
I can see through end of 2026.
To the end of 2026, which reminded me of you, because you had been saying, like, you could see a 10-year down at like 3.5, right?
Right, and you need the simple way to predict the 10 years is to take the Fed funds rate and add 100 basis points. And a normal Fed funds rate is rough inflation, say 2 plus 75 basis points. So that's where we get to 375. So we do need to have 6 cuts over the next year and a half to get to normal, which is where we should be now, but the Fed is clueless and always behind the curve because they don't follow they should follow our CPI-R.
But does that spread, and we could talk more about that. I know. I was going to say, you love that index too. It's been really interesting to keep an eye on it. I was caught by the spread between the 10-year and Fed funds. Do you think that holds, given the tax bill and the fears around the fiscal policy in the U.S.?
Well, we have a unique view, and we've had this conversation before, in that we don't think any of the bond sell-off was related to the tax bill, because everyone expects, or unfortunately, that there'll be fiscal irresponsibility. So that's not new news. What was new news is the Japanese central bank is being very tight. They shrank the money supply by 4.8%. Their 30-year bond crashed. And everybody in the United States always forgets that there's a global bond market. You can ignore global stocks because we have all the leading stocks, but our bonds are just like everyone else's bonds. So when Japan melts, that affects our bond market. And then U.S. commentators look at what's going on in the U.S. and try to explain it, but it's usually incorrect. You have to look. That's why we also publish the global monetary base. That actually caused rates to melt down about a year and a half ago when the ECB was tightening rates.
Talk to me about your CPI-R, because that's your reading on inflation. Mm-hmm. And pretty much every reading on inflation we've seen has been really tame. Mm-hmm. We had a fantastic consumer confidence number from the Conference Board. Now, that survey was over May 19th, and it included the agreement or the reduction of tariffs between the U.S. and China. So the consumer was understandably very happy at that time. But should the consumer be happy?
Well, you know, we treat consumer sentiment as an endogenous variable. So in other words, it's just dependent on what's going on. So it doesn't predict anything. Right. In fact, if you look, consumers consume. They're like woodchucks who chuck wood. Yeah. So and the reason for that is high-income consumers want to spend money, and low-income consumers have to spend money. Like, you can't decide not to pay your rent. So everybody is always obsessing about the consumer when the real cycles come from the investment side, usually, sometimes tech, early 2000s, but a decline in investment, much more volatile. So we would say laser focus on the housing sector and housing starts and not worry so much about the consumer. Like, the consumer confidence is a lot of it's political. Like, the average Democrat thinks inflation's 10 and the average Republican thinks it's 1.
What do you see from your inflation gauge?
That we're headed to deflation if we keep doing what we're doing. Keep in mind, our money supply is shrinking. Oil prices are negative. Those are the two leading indicators, not tariffs. Tariffs are one-time expense. So if the Fed keeps the yield curve inverted like it is now, or nearly inverted, I guess, then we're going to have a recession and deflation.
Interesting. Keep an eye on the next economic indicator to watch for, not the consumer, but the housing starts, according to Jay Hatfield. We thank you for joining us here on set.
We don't have you often enough. We need you to come in more often.
Real talk. Jay Hatfield of Infrastructure Capital Management. Now, coming up, President Trump praises the EU for speeding up tariff negotiations. We're going to go live to Washington next. This is Bloomberg Open Interest.
We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
President Trump there, he has agreed to extend the EU tariff deadline back to July 9th after he'd moved it forward to June 1st. It had been July 9th along with all the other reciprocal tariffs. He spoke with European Commission President Ursula von der Leyen over the weekend. She agreed to accelerate talks. The EU spokesperson responded to the move saying, quote, there is now a new impetus for the negotiations. They agreed both to fast track the trade negotiations and stay in close contact. Joining us now is Bloomberg Balance of Power co-host Kayleigh Lines in Washington. So I guess we're back to square two, kind of, in terms of tariffs. Kayleigh, are we going to get an agreement by then?
Well, that's the question, Matt. I would point out that it really only took 48 hours for President Trump to change his mind between a 50% tariff going into the into effect against the EU on June 1st to then pushing it back to July 9th. So that's just how much things oscillate in the trade space when it comes to this president. The European Union, through this call with Ursula von der Leyen, has managed to buy itself a little more than 5 extra weeks of negotiating time. But that isn't to say that the negotiations are going to get any easier from here, even if the timeline is moved up. And on that timeline, President Trump did say on True Social today, he was informed that Europe already has called to set dates for talks, though no news yet on what exactly those dates are. But we know what those talks will be focused on, at least according to Bloomberg reporting. Europe is particularly looking at some of the sectors President Trump has targeted for sectoral tariff. Think automobiles, metals like steel and aluminum, semiconductors and pharmaceuticals as well. They're going to focus on those areas, as well as the wider issue of both tariff and non-tariff barriers. But therein lies the difficulty of trying to reach an agreement on this, guys, when we consider those non-tariff barriers that President Trump specifically is focused on, things like the value-added tax or digital services taxes. That's going to be a lot harder to come to terms with than just simply taking a tariff rate down on a specific good. So there's still a lot of work to be done between now and July 9th.
Speaking of a lot of work, when we think about the general direction of travel, oscillation was a good word for it, Kayleigh, but in general, you've seen a de-escalation from the thick of it, if you will. What could re-escalate the issue, if anything at all?
Well, we could see something like President Trump initially put forward on Friday, where he decides unilaterally to set a rate of tariff on a country if negotiations are not making adequate enough progress. He has said this for weeks now, that in the coming weeks, he could just tell countries, this is the rate you pay to do business with the U.S. if he feels like talks are not progressing. So we still could see the implementation of tariffs in that regard, even as talks are ongoing between the president's emissaries like Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick and other key trading partners. They're really focusing on a group of roughly 18, according to Bessent, looking at countries like Japan and India, other countries around the world as well. So we're going to be watching to see if there are any big deals in the works. Scott Bessent did say last week that he does think there could be large deals in the coming weeks when he spoke to our colleague David Weston. But of course, we really don't have news of many deals beyond the one that was struck in broad strokes with the UK. So there's still a lot of work to be done in that regard.
Well, we are looking forward to more on that, Kayleigh, more on the taco trade, more on what the Senate does to this one big, beautiful bill. Catch Kayleigh on Balance of Power that starts at 1 p.m. Eastern Time on Bloomberg Television, then again on at 5 p.m. For a deeper dive into all that's going on in Washington. Let's take a look at what's ahead today and this week. Later today, SpaceX is set to launch its behemoth Starship rocket on a 9th test flight. Tomorrow, NVIDIA reports results after the close, while Macy's, Capri, and Dick's Sporting Goods announced before the open.
Plus, we're going to get minutes from the Fed's May meeting, and we're going to round out the week with more Fed speak and eco data, including GDP, PCE, and UMich. Big read on the consumer between earnings and the data itself.
Yeah, absolutely. Coming up tomorrow, Ilana Weinstein, IDW Group CEO and founder, joins us. Keith Lerner of Truist Advisory and Karen Pye of Fiduciary Trust. This is Open Interest.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, Salesforce will acquire Informatica for $8 billion, one of the biggest ever deals for the company for the next phase of AI-driven growth.
Plus, Apple shares coming off their longest sell-off in more than 3 years as attacks from the White House escalate.
And Elon Musk turns his attention back to his rocket company SpaceX and will lay out his vision to all in an X live stream later today. But first, we check it on the markets. Ed, we're kind of rocketing higher on this space as well. We're currently up 1.8%, let's call it, on the NASDAQ 100. You're seeing strength as consumer sentiment manages to show some encouragement, as we see maybe encouragement when it comes to US and European trade talks, and it's game on after what was a down week last week. But you'll look at some of the biggest movers in the index.
Yeah, we have a deal, and that deal is between Salesforce and the cloud data management platform Informatica. $8 billion deal, as you said, $25 per share going to Informatica, and Salesforce saying that they're going to use a combination of cash and some debt to finance the deal. But this is kind of interesting. It's a second bite of the apple. Informatica now $23.80 in the session. Confirmation of earlier Bloomberg reporting. A lot more to learn about what happened, not just in the last few days, but in the last year.
Exactly. And let's get to someone who helped break the scoop on Friday, Liana Baker. It was a Friday story when it comes to this round of M&A, but of course, Salesforce had eyed Informatica a year ago.
We'd been tracking it also since the deal fell apart, but once you have a deal, get scuttled and not happen, you have to be really sure that it's going to happen. So late Friday, we heard that this could be coming, as early as this week, and we sort of went for it here, and we were trying to understand what had changed for Salesforce. Well, for sure, what's changed is that they're paying $2 billion less than they were a year ago, so they definitely look smart in that respect.
Right, a year ago, what changed for Informatica is its shares were above $30 a year ago, and when we broke the story Friday, I think it was somewhere around $20 or so. How Salesforce is funding this, the sort of mechanics of the deal, Salesforce's history of M&A, how much of this was surprising to the team?
So Salesforce is sort of a juggernaut in M&A. They came in the crosshairs of activist investors a few years ago. Both of you covered that really closely, where Benioff's acquisition strategy was under the spotlight. So he sort of took a breather for a few years, and here he's back in a big way with this $8 billion acquisition. You might recall in the fall, we broke another story. Salesforce bought Own, which is a smaller deal at $1.9 billion. So Salesforce still has been doing deals, but this is the largest in a while. Historically, Slack was larger, and they also did Tableau software many years ago. So this is a company that just loves inorganic growth, and it's back on track in terms of getting those deals done.
I mean, they also bought MuleSoft, which, of course, actually competes with Informatica. So how is the regulatory process going to look?
So analysts are watching this overlap between the companies. It'll definitely be a test to see how Salesforce and Mark Benioff are maybe viewed under this administration. So we'll be tracking that closely. But for what we understand, they got this deal done. It didn't stop them from getting it announced, and we'll see what comes next.
Bloomberg's Liana Baker, who leads our deals team. Thank you very much. So let's get to some markets reaction. Janet Mui, head of market analysis at RBC Brewin Dolphin. It's an interesting headline, right, Janet? We have some M&A in the software space. Just as a moment in time, how do you see that playing out more broadly for SaaS and software corners of the tech market?
Hi, Ed. Thanks for having me. I think that's very exciting. I think AI is still driving a lot of this excitement. And what we are looking is that there is some more consolidation in the industry. I think companies want to deepen and strengthen their capability in AI-driven growth in data analytics and CRM management, and also developing further in the cloud. So I guess this is very exciting and sort of builds up further the case for that long-term AI investment.
I'm just looking at shares of NVIDIA. They're up now 3% in the session. The macro event of the week, the macro event is probably NVIDIA's earnings after the market close on Wednesday night. On your desk, for your clients in your world, Is it a macro level event, something like NVIDIA earnings?
Yeah, definitely. I think everyone is very excited about it. I think what we'll be looking at is definitely the profit margins. It is getting harder and harder to defend. And also, of course, the ramp up of Blackwell and how the data servers are basically digesting the inventories. And also sovereign AI. I think that's a very important tailwind for NVIDIA in the future. And I think, of course, commentaries on the geopolitics situation, sales to China and things like that. And also, I think in general, I think the valuations of NVIDIA is not demanding at all. It's only 25 times forward earnings. But I guess the market is still having doubts on the digestion of those AI chips, given that the hyperscalers have already spent hundreds of billions of dollars, and how much of that sovereign AI and Stargate is going to compensate for that. And I think we're still in this digestion phase. So it'll be very interesting to hear how the executives are going to comment on that.
So do you need to hear that bullishness, that ultimate demand being pushed forward, a really enthusiastic guidance coming from Jensen to build around the AI theme once again, outweighing what has been geopolitics that weighs down on some of these hardware names?
I think so. I think we actually need to see a pretty bullish guidance. The problem is that the stock has risen, I think, about 40% since its low. And to get even higher, to break that previous high, I think we need more good news. And as I said, there's still a lot of concerns on geopolitics. I mean, President Trump has canceled that AI diffusion route, but for sure something else is coming. So I guess there's still a lot of concern on the competitive landscape. China is very close behind. I guess we need a lot of good news for the share prices to power ahead.
And just take stock for a moment of the onslaught of headwinds we've had from a geopolitical nature. We're about to dig into Apple, of course, the tariff anxiety there, but also the tit for tat that might come back if Europe does indeed have its eye on big tech in terms of yet more digital services, taxes, ways to respond. Janet, how hard is it to invest in big tech, big US names at the moment?
To be honest, I think the long-term story is intact. I think these are great growth compounders that I don't think people are doubtful of their potential and their long-term growth. But the problem is that near-term, there's still so much uncertainty on the tariff. And I think even if the tariffs are scaled back or paused or whatever, I think at the end of the day, some of these big tech companies that are highly linked in their supply chains will still see some erosion in their profit margin, right? So I guess that's the concern. And the thing is, they're already very big, and it is very hard to grow at such a fast pace going forward. So I guess given the valuations have come back up again after the recent rally, I guess investors are going to be back in a more cautious mode going forward. We need more good news. We need trade deals. We need more AI good news. We need more better economic data from the US and lower inflation, for example.
Janet, is there a corner of the technology sector that's underappreciated by the market?
I think, I mean, for us, right, we are more enthusiastic on the AI picks and shovels play. But as I said, I think the recent rally has moved back up some of those valuations. I think software remains a good place to be, given that it is arguably less impacted by tariff, and I think there's still a lot of innovation going on. I think some of the share price movement in big tech companies, for example, Apple, has been quite negative. And I think obviously it is impacted by geopolitics and tariffs, but I guess investors are also looking for some new innovation, new products, pipelines and things like that, like new features on AI. I think if Apple were able to deliver that, I think that can offset some of that worries and may potentially recover from the recent negative share price reaction.
We're going to be digging into that in but a moment. A little bit more on Apple. Janet Mui, RBC Brewin Dolphin, Head of Market Analysis. Thank you. Coming up, as I say, well, Apple is getting a bit of a reprieve after its longest sell-off we've seen in more than 3 years, but President Trump's tariff threats could introduce more volatility. We're going to discuss that in a moment, but Ed, we've got some breaking news on move in Trump media.
Yeah, did you see DJT, the parent company of Truth Social? So the stock's down more than 9%. The news, it's a pretty simple story. Trump Media is going to raise $2.5 billion US in capital to buy Bitcoin. There was some choppy trading. I think we opened markedly higher. We are now very much down, more than 9%. We'll continue to track that story, Caro. This is Bloomberg Technology. Take a look at shares of Apple, the tech giant finally in the green after 8 straight days of losses. Still, Apple remains the Mag 7's worst performing stock in 2025, having fallen 21% so far year to date. Bloomberg's Ryan Faselica writes today, the iPhone maker faces still more pain, and he joins us now. Ryan, where is that pain coming from the stock's perspective?
Hey, thanks for having me on. So obviously last week we got the surprise announcement about tariffs specifically on Apple if it doesn't bring its manufacturing to the United States. This was later expanded to include all smartphone makers. But I think just the level of political uncertainty remains extremely elevated for Apple. Obviously we saw so much volatility following the initial tariff announcement in April. There was then exemptions provided for certain electronics category, a sort of a pause with respect to China. We saw another tariffs against the European Union, which were also paused. So just the back and forth really has investors and analysts struggling to kind of figure out what is the impact to Apple going to be, how do they navigate this kind of environment, and what is going to be the sort of knock-on effects with respect to its earnings, its margins, with demand, with pricing. Still a lot of very fundamental questions surrounding the company right now.
What's so interesting is we had Gil Luria on the show last week, really talking from D.A. Davidson analysis, saying he's surprised at how poorly Tim Cook seems to be navigating this on a political perspective, but also there's so many other headwinds that are buffeting the company right now.
Yeah, absolutely. So they've already been struggling with their AI offerings. Growth has been pretty tepid, especially relative to other mega cap companies for quite some time. The multiple remains sort of at the higher end of things. There are a lot of issues that have investors kind of looking around and saying, if you're going to buy a big tech company, what is really the argument for owning Apple over other ones that offer stronger growth or a lower multiple or a stronger AI position, or they don't come with this kind of political risk. So certainly all the sort of headwinds are stacked up against Apple in a way that they are not for the other mega cap tech stocks.
Set the scene for us then, year to date for the Mag 7. Apple's down 21%, but what does the rest of the field look like? You cover each of these names.
Other names are doing pretty well. There's been obviously a great deal of volatility, but some names have recently broken back into the green for the year. I think a lot of these companies continue to have a lot of really, adamant supporters. They are still well liked on Wall Street. The most recent earnings season showed pretty durable growth trends. A lot of them deal in market positions that don't have too much tariff impact, like software or just internet services, online advertising. There's some sort of second derivative move if you consider the impact to just economic growth and so forth. But otherwise, the names are doing pretty well. Apple is really an outlier here, and the only one that's pretty close to it is Tesla, although I think I checked this morning and that stock is down about 13% or so this year. So the degree to which that one is even lagging is far lower.
Ryan Flestelica, it's great to have you. Always some really well-read stories. We appreciate it. Look, let's just go back to the nuts and bolts of the Apple story with Carolina Milanese. She's Creative Strategies President and Principal Analyst. And going back to, the torrent of Truth Social posts that were out on Friday, first focused on Apple, but then spreading their way, it would feel, from Trump that all foreign-made smartphones would potentially be looking at a 25% tariff. Does Apple in some way end up having an edge in that?
The phone is still the most valued device that consumers are carrying. And so hitting on smartphones when initially Trump had said that they were going to be exempt is going to be, hard for everybody. If you're looking at the US market, Samsung and Apple are dominating the market. And so having tariffs applied to Samsung as well, who will have limited availability to make devices here in the US, is going to be hard. For Apple, it's all about juggling the short-term and the longer-term prospect, trying to balance not upsetting the president further, but at the same time not upsetting China either, because it's a big market for them as well.
And India, where they've been shifting manufacturing. Carolina, what does Tim Cook do to satisfy all players right now?
I think buying time is probably his best option. And so making whatever promise he can make of investing in the US. Obviously, if you're thinking about repositioning the production here in the US, we're talking way further than the term that Trump is going to be serving. And so buying time for the next 2 to 3 years might be all that is needed for now.
The way that Tim Cook put it in 2017, I think it was on stage with Fortune magazine, is that in China, you could fill a football stadium with specialist tooling engineers. And in America, you couldn't fill a meeting room, with that same level of skill set. All about vertical integration and how the iPhone is assembled and all the different hands that touch one handset. Just try and help our audience understand what it would mean, not to move an iPhone factory to America, but everything else that comes with it.
That is what is impossible to do. I mean, moving the supply chain and then full production here is really impossible unless you're willing to invest, and not just from an Apple perspective, but from a government perspective, billions of dollars in replicating this and investing 10 plus years to do so. I think what you can aspire to do is, an assembled in America, the same way as you have design in Cupertino on the back of a device. That is the short-term hope. Everything else is really more a fairy tale. Apple
shares fell last week when a headline crossed the Bloomberg terminal that OpenAI was buying Johnny Ive's hardware startup IO for $6.5 billion to make a suite of devices. Your reaction, please, Carolina Milanese.
That is definitely pressure that right now Apple could do without. They have Apple Vision Pro, very successful in enterprise from an interest perspective, not necessarily a volume perspective, but hasn't really hit consumers for a range of things from the price point to the ecosystem. So hearing, somebody that has worked for Apple so closely and maybe didn't leave on best terms, coming with OpenAI. So you're bringing together the AI sore point for Apple right now with Apple Intelligence, plus a competition from a Glass or, some kind of XR, AR play. Definitely not a good moment for Apple.
Not a good moment, but only 4 sell ratings on the stock. It's still very close to a $3 trillion company. Can they swiftly turn things around? Can they regalvanize growth here, Carolina?
I do think that we are going to have some of the answer in a couple of weeks at WWDC when we're going to see possibly, like Mark Gurman was reporting, a redesign from an OS perspective, both for iPhone, Watch and Mac, but also hearing hopefully some improvement on the or some development on the Apple Intelligence part. I think ultimately Apple is still, from a vendor perspective, from a consumer point of view, the one that has the strongest ecosystem and that can tie in consumers both from a services perspective and hardware. And I think that the point that is getting people scratching their heads right now is how long it's been taken from an Apple Intelligence perspective. But I still believe that ultimately they have all the pieces that can come together to really continue to develop their ecosystem in a strong way and please their customers.
Carolina Milanesi of Creative Strategies, great to have you back here on Bloomberg Technology. Thank you. Now, coming up, Mark Zuckerberg's effort to get close with President Trump have given him direct access to the White House. But what's that actually done for his company? We have more on that next. This is Bloomberg Technology. Mark Zuckerberg's efforts to win over MAGA world have brought the Meta CEO closer to President Trump and his administration. But according to the latest Bloomberg Big Take, Zuck's efforts have yet to bear significant fruit for the social media company. Joining us with more is Bloomberg's Riley Griffin, one of the authors of that Big Take. It's so deeply reported, and it's a look at how Mark Zuckerberg has almost like changed himself over a period of time to kind of more align with this administration. But the conclusion of the piece is that for Meta, it's not yet opened any doors in a way that helps the company's profile.
Absolutely. My colleague Kurt Wagner and I spoke with more than 50 people for this story, which spans several decades, really. And what we found is that the efforts to pivot towards Trump and his administration have not yet borne the fruit that the company so desires. And one of the case in points of that strategy, and it's perhaps failing so far, has been Mark Zuckerberg's attempts to end the FTC trial that you and I have spoken so often about, Ed. Mark Zuckerberg ended up taking the stand, but that was one of the moments that might show some of the weakness of this strategy.
I love going through the piece. The frequent flyer visualizations of how often he's on his plane trying to go back and forth to Washington. But also what stunned me was just how little respect, ultimately, it seemed that previous President Biden had for Mark Zuckerberg and ultimately for Meta.
Yes, that was one of the most interesting lines of reporting for me too, Caroline. What we found was that the Biden administration did not have a productive relationship with Meta over years, and that President Biden himself, even dating back to when he was a vice president, was incredibly skeptical of the social media giant and Mark Zuckerberg personally. We learned that he called him behind closed doors little twerp, among other perhaps more colorful terms. And this really came to a head during the COVID-19 pandemic as misinformation spread. There was that notable moment where President Joe Biden called Meta, said Meta was killing people as it was spreading misinformation online.
Hey, real quick, how's morale inside Meta right now? You learn very quickly in Silicon Valley that a company's figurehead doesn't necessarily reflect its workforce.
Yeah, well, Meta is full of tens of thousands of employees, so obviously there's a wide range. But what we've found is that a lot of employees are really discontent with this approach. They're holding secret book clubs to talk about Sarah Wynne Williams' memoir, Careless People. They are having wellness checks. Right. Many folks have believed that Meta had done layoffs in an effort to quell dissent. The company obviously denies that claim, but it's sour inside the company.
Bloomberg's Riley Griffin. It's a very long piece. I urge you to go and read it. Some deep dives there. Coming up, cutting the cost of satellite manufacturing. Why Founders Fund is doubling down on demand in the space sector with its latest investment in Endurosat. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Some momentum in the markets, Cara.
Certainly is when it comes to stocks, Ed. Just check out what's happening on the NASDAQ. Best day since about mid-May. We are higher by the tune of 2%. In fact, only 4 stocks of this major benchmark are actually in the red. What's the moon music about? It's about macro. It's about consumer sentiment looking better. It's about the bond market looking a little bit calmer. It's about, of course, that key macro event that is NVIDIA's numbers coming as soon as tomorrow. But I'm also looking at Bitcoin actually not catching that upward draft. It's interesting. 109,000. Look, we still need those all-time highs. But it's notable that we haven't followed stocks higher. Move on and though, have a look at what equities are doing in response to a Bitcoin play. Everyone wants to be Michael Saylor nowadays. The strategy being borne out with Trump, the DJT ticker as it's known, Trump Media, they're going to be selling stock to buy Bitcoin. It sends it lower by 11% at the moment. But I'm looking at PDD, woeful, the worst performer in the NASDAQ 100. This is, of course, the owner of Temu. Well, it looks as though, of course, geopolitics, trade anxiety plays out with profit tumbling some 47%, Ed. But notably, no future path that looks pretty. They have to invest to change up the business model, Ed.
All right, let's go from public markets to private markets and head to space. Bulgarian satellite manufacturer Indurosat has announced it's raised 43 million euros. That's around 49 million US dollars. This latest funding round was led by Peter Thiel's Founders Fund, delighted to bring in Indurosat CEO Raito Raichev and Founders Fund partner Delian Asparov, who join us from Sofia, Bulgaria's capital. And Raito, I'll start with you. You have managed to change the way that satellites are manufactured and also how profitable that business is. So why do you need to raise this money? What are you going to do to expand your production of those next-gen satellites?
Yeah, so first of all, we really believe that there will be a paradigm shift in the way that humanity builds the next future infrastructures in space, which in a simple terms means how do we put multiple new sensors like cameras, radars, navigation systems of the future as fast as humanly possible to orbit, and how do we objectively lower the data to cost as little as $1 per gigabyte of any type of space data. And the way that we approach this problem is basically trying to our best to build a satellite that was from day one designed for manufacturing, which is very unusual in a traditionally very hardware-centric industry where everyone is usually building tailor-made solutions for every individual missions. We believe that's the way to go. We have leveraged a lot of our experience in the region of the Central Eastern Europe concerning automotive designs, medical, robotic industries, and we have tried our best to embed those into the satellite design.
Delian, you are Bulgarian, and I know this is a really big moment for you and important to you. You see Indurosat as being to Bulgaria almost like what TSMC is to Taiwan. Just explain your thesis there.
Yeah, I mean, admit obviously as being a native of the country, I had a predisposition to sort of find an investment here for a long time, but only if it met the sort of standard Founders Fund bar. And as you know, Ed, we've been a big investor in a ton of the leading aerospace companies. Everything obviously from behemoths like SpaceX, where we were early and consistent backer, but also in some of the next generation sort of companies that are coming up. Impulse, led by Tom Mueller, Varda, the company that I incubated, Hadrian, focused on automated CNC manufacturing. But one of the core theses that we wanted to sort of focus on as we see this sort of explosion in the industry was somebody that was focused on mass manufacturing of satellites, but in a way that more closely resembles you were talking about Apple early on in the show, something that looks more like a consumer electronics Apple manufacturing line than how the vast majority of satellites, even Starlink satellites, are assembled today, which is very tailored, one-off, super custom made. If you look at the sort of average American satellite in terms of its overlap with the automotive, consumer electronics, or medical industries, there's very little. And so for a long time, I'd kind of given up on the thesis of actually being able to invest in somebody in this category. The thesis was always find somebody that's like the sort of Dell for satellites. But I'd been catching up with Raicho at Indurosat for several years, and he had very little funding to get going on the company, and so he had to use some of these more consumer electronics, automotive supply chains to build up his satellites, and steadily made them bigger and bigger. Revenues got bigger and bigger to the point where in Q4 of last year, even though know, I'd always had this sort of, negative bias towards Bulgaria, because I was like, God, if I tell Peter that he hired a Bulgarian and he wants to invest in a Bulgarian company, he's going to kick me out of the room, obviously. He's going to say, Del, you're crazy. But at some point, the numbers, the quality of the technology, the culture of the team, the fact that they've, invested into the local university programs to start to train their own next generation talent, that's what I mean when I talk about, sort of the TSMC of Bulgaria, where it's both this national jewel in this very technologically, sort of forward sector, but deeply integrated in the society to the point where, if you're a 15-year-old Bulgarian, sort of physicist or computer engineer or mechanical engineer, all you can dream of is the day that you graduate university and getting to go work for Raicho.
So Raicho, we hear about the thesis. We know that the revenues are climbing, but how can you be like Apple in terms of profitability, in terms of margin? How profitable are you?
Well, there is a lot of components in achieving profitability. I'm happy to say that we went on the market selling satellites in early 2018, and we became profitable that same year, which usually never happens for a space company. Usually they need like a decade at best. And ever since, our business grows between 2 and 3 times year over year in terms of revenue. And every single line of our business today has average gross margin between 75 and 77%. So I think we're pretty close to those type of metrics. But again, we are only focused on the challenges that we really want to bring the industry to a completely new level and scale. And I believe, honestly, at the end of the day, the authenticity of the products and the execution of the team would lead to, anyway, immense market opportunity. And this is what we are hoping to achieve with our new and incredible partners from Founders Fund.
And those partners, Delian, can they be other of your investments? Just thinking of SpaceX, as you mentioned, Varda, which you, of course, are president of. How much are you going to turn to Endurosat for your equipment?
Yeah, I mean, look, as we're sort of looking at the next generation vehicles across the portfolio. If you just look at the economics of what Raicho is offering, it is just vastly differentiated relative to anything that you can find either in the European or the American market, right? If you think about the sort of traditional aerospace suppliers, think folks like Airbus, Raytheon, Lockheed Martin, Blue Canyon Space Systems. All of their components are these things that are based off of like 1970s technologies that have been ever so slowly iterated on. And there is benefit to that in that they have flight heritage, but they're somewhat stuck and not able to take that sort of monumental leap forward. So I won't comment on like the specific companies, but I can already say is part of how I got alerted to Enduro was because we already had a significant amount of the Founders Fund portfolio and some of the broader Silicon Valley funded defense tech and space startups already as customers of his. As I started to analyze everyone, I realized there was an arms dealer, there was a Dell for satellites already. It just happened to be this Bulgarian company that, for a long time, I just wasn't sure that I could take seriously, given that, I knew that I had this predisposition towards Bulgaria. And to have these margins that we're talking about, I mean, the fact that you can build a space company profitably, growing quickly, at 70+% margins, I mean, those are the things that you see in, sort of consumer electronics behemoths like Apple. But if you look at the average American aerospace or defense company, these are all best case 20-30% margins, burning hundreds of millions of dollars before they ever get to any semblance of profitability. And all of these things never get to this level of margin. This is why when you look at everything from Planet Labs to Maxar to Iridium, all these companies that operate in the satellite world, they never trade above 3x revenues because there's no growth and there's no profitability. When you look under the hood at Raicho's business, it's insane to see these metrics. You almost look like a traditional Silicon Valley SaaS company in terms of margin and growth.
Raicho, let me ask you this to finish. What's your strategy for manufacturing in the United States in the future?
I'm proud to say that the majority of our business is already in the US, and we are heavily involved in supporting the local ecosystem. We have quite advanced team in Denver already. We are assembling and operating satellites for our US customer base from US. So I really consider that there is no such dramatic difference between what we do in Bulgaria and in Europe and generally, and what we are planning to even expand further in US. Just to give you the context, we have already invested significant amounts, millions, just starting last year, way before there was this tension that arrived between the two continents. And I think this tension will be very healthy for our business. I mean, we need to learn how to do local stuff better than anyone else. We need to empower the local ecosystem. And I think we also bring the knowledge and the know-how and a little bit of innovation that will be very healthy for the US market in general.
Raicho, CEO of Endurosat, Delian Asparov, partner at Founders Fund. We appreciate your time. Thank you both from Sofia, Bulgaria. Coming up, a new company started by the founder of quantum computing firm Rigetti. It aims to use quantum to address cost and energy bottlenecks in scaling AI. That's next. This is Bloomberg Technology.
The name Chad Rigetti may be familiar to those in the quantum computing world. Now the quantum computing entrepreneur and physicist is launching a new company called Sigildry. It aims to use quantum to address cost and energy bottlenecks that are associated with AI. Delighted to say Chad Rigetti joins us now. I think we will get to the backstory of your involvement in the earlier days of this industry. But what is the objective of the new company, and what is different about the new company's technology?
Hi, Ed. Great to be here today. Sigildry is building quantum-accelerated AI servers to exponentially speed up training and inference for these large models. As you've heard about, there's growing energy requirements, power requirements that are very challenging to meet, and there's growing costs for training new models. And ultimately, quantum can provide a solution to that with these exponential speed-ups. In the last few years, there's been new algorithms developed that can exponentially speed up things like stochastic gradient descent or low rank adaptation that are critical for training and inference in large models and really bringing about the accessibility, affordability, and sustainability of true widespread adoption of AI.
We were recently at NVIDIA GTC's Quantum Day. We did a special show where many sort of the leaders in this field joined us. And kind of what struck me is they all sat there on stage with NVIDIA CEO Jensen Huang, is how many companies are working on this? How many publicly traded companies? And I give you that preamble to ask, why do we need a new company focused on this task? Why can the technology been developed by all these others, including the namesake company you founded, not crack it themselves?
It's a great question, and I've thought about that as well. And ultimately, that led me to starting Sigildry with my co-founder, Idalia Friedson, who also worked with me at Rigetti and helped take the company public in 2022. Ultimately, all of these companies that are out there today are making tremendous progress. There's been tremendous advancement just in the last 3 years alone. New qubit types like neutral atoms and photonics have advanced as much or even more than superconducting qubits have. And ultimately, what we see is an opportunity to combine these different modalities within a single fault-tolerant architecture. And we thought about, and then on the flip side of that, to take a laser focus on accelerating these compute challenges in AI. Ultimately, over the past 2 or 3 years, AI has become so useful and so widely used that it's redefined, it's basically created a new abstraction layer for computing hardware. And with that, computer hardware itself needs to evolve and change. If you look at the quantum computing companies that are out there right now, even the public ones, and the one that I built in Rigetti Computing, all of those roadmaps, their plans for 5-10 years out were locked in before AI became the dominant compute paradigm. And so today we see an opportunity to bring a new architecture that is specifically focused on accelerating training and inference, on lowering the cost and energy requirements, and also at combining different qubit modalities, because all the companies today also are siloed with respect to their technology choices, which again were made before AI became the dominant paradigm. So we're bringing multiple different qubit types together within a single fault-tolerant architecture explicitly built for AI.
Chad, do you need more money to do this? Because at the moment you're backed by Y Combinator. I'm sure you've got some money made on your previous company, but how much do you need outside investment?
Well, of course, this is deep technology in the end, and the size of this market, if you can crack this, when quantum really comes online and starts to impact AI training and inference costs, it's going to be $1 trillion market. And we see this as completely inevitable. Ultimately, nature itself runs on quantum mechanics. In the most information-rich environments at the lowest level of nature, we use quantum mechanics to process that information. And quantum reflects that, mirrors that reality, and ultimately is a more efficient way of computing long term. So we're going to use this in conjunction with GPUs, in conjunction with large-scale classical infrastructure. It's an enormous opportunity. And ultimately, we believe that when our multi-modality quantum architecture comes online, that is not, other single modality architectures aren't ultimately going to be able to compete with it. Yeah. We will absolutely need to raise additional capital going forward. The company's just getting going. We're launching and publicly announcing the company today. So we're in the early stages, but we're really excited. Our team is growing very fast, and we're very excited about what the next few years holds.
Chad, to be personal about it, how has Rigetti responded? It bears your name. I'm sure it's a help in many ways for you because your name is still so legendary within quantum, but how did they respond when they're also teaming up with Quanta in Taiwan, which is a server maker, and looking at the adoption of quantum there?
Yeah, well, ultimately, you need to ask Subodh and the team there. I think with respect to the progress towards AI, these are deep architectural choices that need to be made early on in establishing your hardware roadmap and your company vision and plan. You need the DNA. You need to, early on in the organization, and once those things get locked in, there are forces that make it very challenging to adjust that vision, to adjust those roadmaps, because it relates to all of your partnerships, it relates to your talent base, relates to how you think and talk about the technology internally in your culture. So ultimately, we think being started from the very get-go, focused on AI as the singular killer application for quantum technologies, getting the right team together very early on and developing an architecture, leveraging multiple different qubit types that are needed to ultimately reach the combination of cost, speed, and scale to unlock these AI applications is the winning approach to this.
Chad, it's great speaking with you. Chad Rigetti, his new company, Sigildry. We appreciate you joining. Now coming up, BYD shares they extend their losses after announcing price cuts to combat competition at home in China. More on that next. This is Bloomberg Technology. Shares of China's BYD, they extended losses for the second day in its Hong Kong trading. They're down here in depository receipts as well. This after the electric car maker announced sweeping price cuts of up to 34% on some of its vehicles. That's as competition at home intensifies for the sector. Bloomberg's David Welch joins us now. How fierce is the price competition in China, David?
It's the one market where you really have price competition is in the Chinese market, because the domestic players they so dominate their home market, and there are very few imports into the market, that tariffs aren't really wreaking havoc on it the way it is in other parts of the world. So you don't have companies looking to raise prices to deal with tariffs. They're all domestic anyways, and they get all of their parts, batteries, everything domestically. So they don't have that kind of pressure. The pressure is still there, as it has been for a few years, to lower prices and gain market share, probably try to get some of the foreign players out of the market. That's been going on for a long time. That's why General Motors and Volkswagen have struggled. That's why Tesla is struggling. And I think you have companies like BYD and Xiaomi who have they've had a lot of growth. They want to keep it going, so they're going to keep slashing prices too to gain that market share.
You mentioned Tesla. The other battleground that we compare Tesla to BYD on is Europe, and the data over the holiday weekend in the US was that Tesla is suffering in Europe because of the political backlash of Elon Musk. There's also BYD doing well there.
That's right. The Chinese automakers have done very well to gain a lot of ground there. And Tesla's got a lot of problems in that market. I think Europeans, particularly with this new round of tariffs, 50% being announced by Trump, Elon Musk being close to Trump, I think that's going to continue to hurt the brand. It's going to continue to kind of put a shadow over Tesla in the market. They've also got stale product. The Europeans have a lot of EVs now. Chinese competition is there, even though that's getting hit with some tariffs. But it's not good for Tesla in that market, and I think only fresh product would help them out. Even if Elon were to say tomorrow he's quitting Doge and going back to running Tesla, that doesn't really change what's happened with his brand in terms of the politics with some American buyers and with a bunch of European buyers. So that trouble's going to stick around for a while, I think.
Bloomberg's David Welch in Detroit. Thank you very much. Stick with Elon Musk. He's set to address his SpaceX workforce today. Among the discussions will be his long-term goal for the company of sending humans to Mars. All this ahead of a scheduled test flight of the company's Starship rocket, 6:30 p.m. local time. Bloomberg's Lauren Grush is here. Set the scene. You and I used to attend these kind of Elon big picture Starbase moments in person. What are we expecting him to talk about?
Yeah, I would say I would expect probably some of the same hits that he normally does. He gives these Starship and Mars updates about once a year or so. But, every time he does give one of these discussions, he gives a few new tweaks. Maybe there's some new timelines, some new changes, new upgrades to the hardware for Starship or to the plan. So, I think we'll be listening for some of the same old phrases. Preserving the light of consciousness is a big one, but also looking forward to some maybe updates on timelines and what we might expect in the year ahead for certain milestones that they need to achieve.
Well, big day for Starship. How are we bracing ourselves? Because the last two tests have ended in explosion.
I would say the stakes for this flight are particularly high because of those explosions you mentioned. The last two flights did not end well. Both ended in debris streaming over the sky, over the Gulf. And so hopefully they have fixed the problems from those two flights. SpaceX did provide an update saying they know the causes for both of those explosions, that they were actually distinctly different in terms of what caused them, and that they have provided the appropriate design and hardware fixes.
Right.
So we'll see if that holds. I think we'll all be holding our breath at about the 8-minute mark, which was when both of those flights terminated early.
Lauren, we just have 20 seconds, but remind us the ultimate goal, which is getting humans to Mars and how Starship fits.
Yes. So Starship is the primary vehicle for which SpaceX intends to send humans to Mars. Also has a contract with NASA to land humans on the moon with the vehicle. And eventually Starship will be the primary vehicle that SpaceX uses to launch everything in the future. So a lot is riding on this vehicle.
Bloomberg's Lauren Grush. A busy day. We appreciate it. Now that does it for this edition of Bloomberg Technology, Ed.
Tune in tomorrow for a special edition of Bloomberg Technology, looking at NVIDIA's earnings. That's 6:30 p.m. Eastern Time, 3:30 p.m. Pacific. And big thanks to everyone that tunes into the podcast, listen to the podcast. You know where to find it. Online on Apple, Spotify, iHeart, and all the Bloomberg platforms. This is Bloomberg Technology.
And we are live from Bloomberg's World Headquarters in New York. I'm Shanali Basak.
And I'm Tim Stenovec. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
And Circle is set to go public as crypto companies increasingly tap the public markets to raise funds.
This comes as the U.S. Congress debates stablecoin bills, with the Senate version moving forward last week. We've got the details.
And Trump media takes a page out of Michael Saylor's playbook as it agrees to raise $2.5 billion in capital to buy Bitcoin.
That's all ahead right here on Bloomberg Crypto. First, though, let's take a look at how Bitcoin is outperforming those old school assets. So last week, stocks, bonds, and credit posted the worst synchronized sell-off since March. But check out what Bitcoin did. It posted its sixth gain in just 7 weeks. Remember, the Treasury market rebelled against President Trump's tax bill. Crypto rallied. Interestingly enough, it was also at the same time that crypto deepened its institutional street cred as policymakers in D.C. normalize stablecoins, Shanali, for mainstream use.
And I'm watching a roadshow, Tim. We are looking at IPO news today. Stablecoin issuer Circle hopes to raise up to $624 million in an initial public offering 24 million shares for $24 to $26 a piece. The ticker will be CRCL. It could start trading as early as next week in an offering led by JP Morgan, Citigroup, and Goldman Sachs. The company took in roughly $600 million in revenue for the first 3 months of 2025, and it's profitable.
Well, as I mentioned, Congress is working through that Genius Act to integrate stablecoins into mainstream finance. Tether is the largest issuer of stablecoins, and CEO Paolo Ardoino joined Bloomberg last week to discuss whether the bill changes his plans.
It's important to us to see how the Genius Act is in fact distinguishing between foreign issuers and the domestic issuers. We believe in the importance of USDT as the most used digital dollar in all the emerging markets in developing countries, right? The main interest will remain outside the United States, but also we are open to create a domestic issued stablecoin that will be competitive under the US.
Let's get to the latest on the stablecoin bills with Bloomberg Intelligence senior U.S. policy analyst Nathan Dean. Now, while this is very promising for the crypto industry, it might be equally as promising for mainstream financial institutions that want to get in. What did the crypto industry get and not get out of this bill?
So what the crypto industry is certainly getting is the first step for Congress to actually adopt anything with crypto, really. I mean, for the last couple of years, the cryptocurrency industry has had an enforcement albatross across its neck. And now Congress is actually most likely going to pass within the next month or so this legislation that will give the issuers ability to register, an ability to work with regulations, because stablecoins have been in this regulatory gap. Now, I don't think it's going to be like, this isn't going to be a cryptocurrency framework. That's going to come later in a separate bill, but this does get this idea that Democrats and Republicans can come together and pass something on crypto. I would just caution, however, is that even though this bill could pass by June or July, a lot of the language in here requires the Federal Reserve and the Office of the Comptroller of the Currency to conduct rulemakings, and that could take another year to actually see the specifics of what comes out.
So what would be the implications of that, Nathan? What are you telling clients right now when they're trying to understand a timeline of when we could actually see some of the stuff in this bill not just become law, but make those changes that these advocates want to see?
Yeah, so, there's a lot of sentiment that once this bill passes, it's almost like a retail adoption that crypto is going to go forth and really move forward here. And what we're just telling our clients is just remember that the institutional portion of this is going to take some time. Now, there's going to be a proposal. There's going to be multi-100-page comments. This is going to get finalized probably in mid to late 2026, assuming that this bill moves forward. And again, that enforcement albatross is not going to be there. So that's not a bad thing. But I would just say is that we are going to have to see additional more language for the compliance and the risk folks at these companies. If you're on the trading side or the speculation side, you're really not going to see much impact of that.
Nathan Dean of our Bloomberg Intelligence team down there in Washington, D.C. Nathan, thanks so much. Well, now Wall Street's top banks are discussing the issuance of a joint stablecoin. This according to the Wall Street Journal, which says the stablecoin is subject to legislation and demand. Last week, Kraken announced plans to offer tokenized equities for its non-U.S. user base. Here's co-CEO Arjun Sethi on Bloomberg.
These types of products, it's not going to be just us, but anything that's happening in the crypto protocol ecosystem or decentralized, is that we're letting people get access to be able to innovate on behalf of U.S. customers in the long term, on behalf of European customers and rest of the world customers, is that you're able to finally, in one place, get access to global liquidity, access to more products, and not part of one, again, walled garden.
Joining us now for more is Bloomberg's Michael Regan, who leads our crypto coverage. Mike, as I mentioned, it's subject to legislation, but also demand. From your view, as one of the leaders of the crypto team, what is demand for these products?
Well, it's interesting. I think what they're picking up on is the idea that demand for stablecoins has sort of spread beyond just the crypto market. I mean, stablecoins were invented to be just the dollar sort of surrogate in crypto markets because it was hard to on-ramp and off-ramp regular bank accounts into to certain crypto exchanges. So stablecoins filled that niche. But now I think what the banks are picking up on and what a lot of fintechs are picking up on is that there is potential to use stablecoins in regular business transactions. Especially if you go cross-border payments that can sometimes take days and be very expensive to execute, can be done for small fractions of the cost with stablecoins and almost instantaneously. So from a traditional banking standpoint, there's an attraction there, and you can see why they, as the journal reports, the biggest banks are interested in this. A lot of fintechs, Stripe acquired Bridge, a stablecoin infrastructure company. Visa is planning to offer cards that actually pay out from stablecoin balances. So it's really showing this sort of, the old cliche, people are bullish on the blockchain technology, but not necessarily Bitcoin. People are really bullish on what stablecoins and crypto can afford in financial transactions beyond just the crypto markets into traditional payments and cross-border payments.
Mike Regan, we thank you so much. We're looking forward to seeing where the story goes. It's not just the banks. Of course, we are seeing a lot of those fintech companies, as Mike was talking about. And just today, we learned that payments processing firm WorldPay will allow customers in the U.S. and Europe to make disbursements with Circle's stablecoin. WorldPay's head of fintech growth and financial partnerships saying that this, quote, clearly solves pain points in today's payment ecosystem. We haven't had anything come along like this that's disrupted cross-border payments in this way in recent memory. Joining us now, Anna Yuan, founder of Purena and former head of stablecoins at Solana, another company that's much in the news these days. Anna, interestingly, you see the banks getting in. You've seen the Bank of America CEO previously say that he would consider launching a stablecoin on his own anyways, let alone the banks banding together. Realistically, is a bill better for the crypto industry, the core crypto industry, or is it actually a great thing for core Wall Street to get in on this as a new business?
Yeah, I think for this bill that's specifically structured for full collateralization, it's much better for onshore U.S. stablecoin companies, and you can see that banks are kind of fighting back on that. Banks are saying, oh, but we want special treatment. We want fractional reserves. We want to be able to lend it out. Yet, I think this bill is extremely beneficial for the U.S. to keep dollar issuance and stablecoin issuance onshore, because this is a gold standard that the rest of the world is going to follow. And without that, as Tether CEO was saying, Paolo, last week, that they've chosen historically to issue fully offshore, and that's not great for regulation.
And we've talked about the benefits for the companies that are behind this and for the industry. But when you think about it from the perspective of a consumer who may not even understand necessarily what a stablecoin does, what is the promise there?
The promise is borderless, 24/7, permissionless accessibility of the dollar. And previously, if you're someone who lives in a country with poor ID issuance and you may not have a national identity, it's impossible for you to access the dollar. All you can get is like second-hand, third-hand dollar bills. And now everybody, we've seen in the industry that people really want dollars because they want to get out of inflation or they want better investment products. But where Solana and Purena are ahead of most of the industry is that not only do we see demand for stablecoins as just the dollar, but we're seeing dollar-based and U.S. economy-based investment products coming on chain, which is what we were talking about at Accelerate last week.
You know, it's interesting. Sometimes when you try to pay somebody else via your credit card through one of these online apps, you'll see that you have a fee. Sometimes a fee that can be not great, right? I mean, sometimes they're quite high. If you look at what you can do with stablecoins, if you're making a peer-to-peer payment on Coinbase, for example, that fee is zero. And so I'm wondering what that cost is to financial payments person to person. Do you think that that fee goes down to zero across products because of what stablecoin can do?
I don't think that fee goes down all the way to zero. I think in different ecosystems, for example, on Solana or on Coinbase, on Binance, you can pay with zero fees. However, for businesses and individuals, eventually you have to pay outside of the ecosystem. Then you incur a fee, because naturally a lot of people tout that, oh, credit cards are charging 3% and stablecoins will be zero. I actually think that's a faulty argument, because there are regulatory AML costs to anything you do. And the moment you touch fiat or you want to work with regulated financial institutions, which is almost all the businesses, you have to incur costs.
Who loses out in a world where there are seamless, low fee or no fee, cross-border, peer-to-peer transactions? Is it credit card or large companies such as those? Is it central banks in countries where inflation is high? Who loses out here?
A couple of stakeholders. One is central banks that have been extracting value from their population definitely loses out. They don't have the ability to control capital as well, and we've seen that with countries like Nigeria and China. The second one is banks that have refused to innovate. We see that fintechs are catching, like Robinhood and Stripe are going full steam at adopting stablecoins, but the traditional banks that are still charging users like $25 to send a wire, that's going to go away because people are going to figure out that they can send stablecoins very, very quickly.
Perena founder Anna Yuan, gonna have to leave it there. Thanks so much for joining us. Please do come back again soon. Well, coming up, we're gonna head to the Bitcoin 2025 conference. It's happening in Las Vegas. That's where Blockstream CEO Adam Back is speaking along with members of the Trump family. And to access all of the latest data on news on crypto, just check out CRYP Go on the terminal.
Now, some of crypto's biggest names, from Michael Saylor to David Sachs to Senator Cynthia Lummis, are descending this week on the Las Vegas Bitcoin annual conference. The Trump sons will also be speaking. And remember, today, Trump media announced plans to raise $2.5 billion to build a Bitcoin treasury. Bloomberg's Anthony Cormier is at the conference. He joins us now. A lot of headliners. Now, what do you expect in terms of new news coming out of the lineup?
Oh, goodness gracious. I don't know what they're going to say, but they are certainly exultant. Mine is going to be the crypto capital of the world. So I expect that we'll hear a lot of that refrain this week.
Hey, Anthony, just share with us what the
world. So I expect that we'll hear a lot of that refrain this week.
Hey, Anthony, just share with us what the vibes are on the ground a little bit, especially in the context of the involvement of the Trump family. You know, we've spoken in the past to Eric Trump, who denied that there was any sort of conflict of interest. But I do wonder if people within the community are concerned that there could be picking of winners and losers within the crypto industry.
I don't feel that. It's a great question, but I don't actually see that here on the ground. I am getting a sense of triumph, right? That the president is into this, which means a rising tide will lift all boats. I do not get any sense that he's going to be able to choose who's the winner and who's the loser here. In fact, you walk around the facility and you'll see all kinds of Trump memorabilia, hats and shirts and all kinds of pro-Trump stuff here. So I don't get the sense that they're worried about his involvement or his family's involvement.
Anthony, you're going to have to leave it there. We're going to let you get back to everything happening at Bitcoin 2025 in Las Vegas. Really appreciate you joining us, Anthony Cormier of Bloomberg News. Well, joining us now is one of the Bitcoin 2025 speakers, Blockstream CEO Adam Back. Adam, good to see you. I want to just follow up on what we heard from Anthony just now and really get your view of the way that we're seeing mainstream adoption of this technology accelerate during this administration. What are you seeing on the ground? What are you hearing from partners, from potential partners at Bitcoin 2025?
So there was an industry day yesterday where a lot of public companies that have Bitcoin strategies in play speaking. Apparently it's now at around 80 companies globally. Of course, the most recent just mentioned is Donald Trump's media company entering their treasury play. So really an area where enterprise adoption is picking up, and Bitcoin is a treasury asset for public companies as well.
I'm wondering which company that was. It's interesting. PSQ Holdings, which has Donald Trump Jr. On its board, is surging today on the heels of exploring a crypto treasury. To Tim's question earlier, the Trump family has been very involved in the crypto world. When you think about stablecoins, when you think about treasuries tied to Bitcoin for companies, are they absorbing more money in the space, or are there enough riches for all?
Yeah, it's a question I had talked about with a banker recently, which is how scalable is the treasury company approach? I think ultimately it's extremely scalable. It's the largest arbitrage of the century probably, which is sort of arbitraging the US dollar, euro, fiat denominated current world with the Bitcoinized future in a few decades. And so if you think about the addressable market of that being in the $100 trillion to $200 trillion range, there's lots of scope for, even extremely large companies with large cash reserves like Apple, Microsoft, and so on to enter it without making a dent in this market.
To Shanali's point, are you concerned at all about potential conflicts of interest given the proximity of the president's family being involved in this industry? The same question to you that I asked Anthony moments ago, that winners and losers could be picked within the industry.
Well, I think they're all public companies, right? So they're having to compete in the free market. So, ultimately there's quite a lot of competition and some very fast-paced companies in the sector. Some of them are, smaller companies with a high velocity. Some of the big companies with established businesses. So we'll see how that shakes out in the market. It's generally positive, I think. The current administration in the US improving the regulatory environment for Bitcoin and Bitcoin Layer 2 and Bitcoin settlement companies.
One question I have is what the crypto industry starts to look like in terms of dollars brought in by institutional investors outside of Bitcoin. You saw just a week ago Solana, for example, not only hold a massive conference that drew a lot of crypto native investors, you also saw them strike a deal with Kraken to tokenize equities outside of the United States. Do you think that Solana, among other types of crypto assets outside of Bitcoin, can start to become more mainstream?
No, I don't think so, really. If you look at the overall metrics, the so-called Bitcoin Dominance Index is up more than 2 times in the last sort of 18 months or so. So really, the lion's share of the enterprise adoption, sovereign wealth funds, pension funds, public companies, ETFs, it's all flowing into Bitcoin. So I think Bitcoin is really the only sort of commodity with clear regulatory coverage and, no CEO, no company in charge. So I think all of these companies are effectively startups and some kind of ambiguous regulatory coverage security.
Given how well these startups have done, especially over the last few months, Adam, and given the activity that we're seeing in the space, what would you say to the institutional players out there who have not yet necessarily adopted this technology or gone all in on crypto that some of these smaller companies have? To what extent, in your view, do you think their business model is at risk?
You mean the early stage, sort of recent Bitcoin public companies?
Yeah, I would say. Well, I would say the main U.S. institutions that we talk about all the time, traditional brick and mortar banks like the Big Five.
Right.
Would you have a message to them that says, we're actually making a big impact when it comes to this technology. You guys need to pay attention, or else you're going to be left in the dust. Is that where we are right now?
Well, I think there's two tracks. One is Bitcoin, the asset, and there the traditional financial institutions are becoming quite active. Every few weeks you see, a big entity like a competitor, Fidelity, offering Bitcoin-related products to market. You've got the BlackRock ETF, which is record-setting. So I think the Bitcoin institutional adoption is here and coming fast. Those things take a while to mature because they have to develop product playbooks and training. And then the other side of the equation is the kind of wire transfer banking, where stablecoins are starting to provide a better banking experience, basically. So you get 24/7 banking. You can send a wire transfer at a weekend to somewhere in Asia and have it get there in an hour. So I think the banks have some catching up to do in terms of user experience, let's say.
Adam Back, the CEO of Blockstream, we thank you so very much for joining us, of course, on the heels of Bitcoin 2020. It's going to be a busy week for the crypto world. Now, coming up, outgoing CFTC member Summer Mersinger says perpetual crypto futures are coming to the U.S. More of Bloomberg's conversation with her next. This is Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation. It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
Perpetual crypto futures could soon trade in the U.S. with applications being reviewed by the CFTC. That's according to outgoing CFTC member Summer Mersinger. I spoke with her last week.
Those can come to market now, and we're seeing some applications, and I believe we'll have some of those products trading live very soon. It would be great to get that trading back onshore in the United States. I think it's unfortunate that it has been driven offshore for so long, and the fact that we can have that here in the U.S. and under our regulatory framework is a really good thing for these markets and will be really beneficial to the industry broadly and to our economy here in the United States.
Well, that was just some of my conversation with outgoing CFTC member Summer Mersinger. So perpetual crypto futures could be something that we see, quote, soon.
You know, we've been talking a lot about where the leverage comes from in the crypto space after we saw the FTX-fueled implosion that really wiped out a lot of the brokers in the space.
That's exactly where my head went. I mean, what happens if this product becomes available, if we see or when we see some sort of decline in the price of some of these assets?
Well, it could draw a lot more retail interest in. Of course, retail investors, even in regular way stocks, have been very interested in the idea of leverage. Let's see where it all goes, Tim.
Well, that is going to do it for Bloomberg Crypto. Join us again next week right here from Bloomberg headquarters. This is Bloomberg.